Oil prices have tumbled to their lowest level in more than 21 years, with crude storage facilities filling rapidly as the coronavirus pandemic continues to crush demand. The May contract of US West Texas Intermediate or WTI futures have fallen to $11.82 a barrel on Monday, down more than 35%. It had slipped to as low as 11.04 earlier in the session, to register its lowest level since December 22, 1998, before paring losses. Now, to be sure, the sell-off of the May contract comes ahead of its expiry on Tuesday. The June contract of WTI, which is more actively traded, however, stands at $22.85 a barrel, almost 9% lower. This comes amidst heightened concern that the volume of oil held in US storage is rising sharply, with the coronavirus crisis compounding the problem by dramatically reducing the consumption. The current forward crude oil curves for Brent and WTI are now in very deep contango, but the contango is also very front-loaded. Now, for those who are not aware of what I'm talking, and what is a contango? A contango market implies that oil traders believe that crude prices will rally in the future, encouraging them, therefore, to store oil now and to sell them at a later date. The curves are saying, by curves I'm talking of the US oil curves, the WTI and the Brent crude curves. I'm not talking of the COVID-19 curves. So these curves are saying that we have a big problem with the storage of oil right now. The general market view seems to be that a global economic trough and the oil demand trough would be April 2020. It is possible, and some analysts say that the problem of the storage capacity should vanish rapidly because oil demand is expected to rebound strongly in the second half of the year, while inventories will draw down sharply. Well, I don't think so. I do not agree with this at all. Anyway, these were some analysts, but right now down 30 plus percentage. US crude has dealt a lethal blow, and the Dow futures are currently down more than 500 points. What happens in the trading sessions today and thereafter is another question. One more thing that you need to look or take into consideration is that the very important feature of oil is not only the demand destruction, but the fact that the storage facilities are now completely full or full to the brim now, nearing it. Now, the transportation facilities much required to move oil to the consumer is also missing. So that is another reason why the storage facilities could be full. So it's not pure demand destruction. That transportation has been hit very badly because of the lockdown conditions in many of these countries where the coronavirus pandemic is still yet, or rather is yet to run its course. So do not forget that. Another thing that you must take into consideration is that the US markets have not yet factored in a second wave of coronavirus pandemic. Right now they are assuming that Gilead Sciences remdesivir will be able to take care, and there will not be a second wave of coronavirus cases, whereas you are seeing that the cases although have ebbed down a little bit, but the curve is yet to flatten. In fact, global cases now over 20 or are over 2.4 million, and the deaths are also rapidly rising. But Spain is now reporting 200,000 cases. So Spain's cases have also risen quite a bit, and the curve in the United States is yet to flatten itself. So there are so many things which are there are so many moving parts, and none of them seems to be fulfilling the expectation that the curve of coronavirus cases has flattened in any way so far. Although the expectation has been, there have just been some expectations that a vaccine is round the corner, and especially the Gilead Sciences remdesivir has given in good hope, but that itself has not turned the corner so far for the markets. Looking to the markets today, therefore, could be a soft opening. There could be a little bit of correction on the upside, 11:30 to 1:30. New York time session is dictated by the Dow futures, because don't forget, not only United States but even the London FTSE is composed of some major energy indices, major energy companies. In the United States, you have Exxon. In London, you have British Petroleum, and there are such many Total, many companies which form a part energy heavy index that London FTSE is. It does compose of many of these indices, and therefore, when the oil prices plummet so badly in one day, it is bound to have its impact on the indices, the London FTSE, the Dow Jones, and this is what we are seeing. This, if it continues, and I'm expecting only a mid-market revival today, this can continue into the opening sessions in Asia tomorrow, because there is a demand destruction that is getting affirmed in these low oil prices, and that's something that, although low oil prices can be good for the consumers in countries such as India and China, who are very import dependent as far as crude oil is concerned, but they definitely also have an impact on countries which produce oil, like America has got to do with shale gas. It's in bad shape. Other countries are also not doing so well, and therefore this falling oil prices is weighing heavily on the indices of the countries which are energy producers, and they are definitely finding their stock market indices could also get a beating in the process. So it's going to be a mixed day, therefore, and unfortunately, whatever happens in New York does carry forward or to the next day, or does reverberate across the Asian markets tomorrow. So in any event, a mid-market revival could be seen today on US markets, and a sharp one, but markets otherwise will weigh in this 34% drop in the May futures of the US West Texas Intermediate oil. Happy investing. Take care. Bye-bye.